Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about property taxes and the difference between the property tax and ad valorem tax and severance tax and all these different forms of taxation that you may encounter when dealing with producing and also non-producing oil and gas interests, because there can be a big distinction depending on the state. So, Justin, this is always one of those interesting areas where people ask about taxes and what do I owe? And then, obviously we're always focused on income taxes, and that's a pretty straightforward situation with royalties. But when it comes to property taxes, it can be kind of confusing.
You nailed it, Matt. And, no two answers are alike, unfortunately, in this area, because each county has its little caveats in the ways that they handle it. And then each state can be different as well. So it can be a really hairy place that takes some time to figure out what you're supposed to be doing.
Yeah, and this ties back to a question that we got in the July listener questions episode where I forget the name of the listener, but he wrote in and said, hey, I've minerals in this one state or this one county, and I get this really tiny tax bill. It's really a pain to have to deal with every year. What happens if I just don't pay it? And so after that, I realized we hadn't really covered this topic in depth. And so I thought it was a good time to really dive into property taxes and what you should know and at least be aware of and what to check for if you inherit minerals or if you acquire minerals, and just to make sure that you're staying on top of the property tax situation, because it can have a big impact on potentially losing the property.
Yeah, Matt, it can really, and there's penalties that come in, and it can be a pretty stressful situation once they finally find you or you find out what you owe. It can be a lot of hoops to jump through. And really, I think property taxes come down into really two buckets. You've got the taxes that come in on producing minerals, and then you've got non-producing minerals. And the tax on those can be handled differently based on the state that you're in, and sometimes even the county you're in that state. Only two things guaranteed are death and taxes, and this is no exception.
Yeah, that's right. And, speaking of taxes, we have covered the general topic of taxes on previous episodes, and we really focused on income tax and the different ways that that is handled. And so there are really 4 separate episodes where we talk about that in depth, and we'll link to all of those in the show notes. So if you haven't gone into detail about learning about property taxes versus income taxes and those types of things, capital gains taxes, if you sell minerals, for example. We have episode 20 where we talked about different types of taxes on minerals and royalties, really focused on the ordinary income versus capital gains, and then the percent depletion deduction, which is a really big benefit that we have as royalty owners to be able to deduct from our income tax. So be sure to listen to that. And then also did a little bit of an update on that in 2022 in episode 146. And then we had some other potential tax law changes that were discussed around kind of that time frame, and that was in episode 118, where we talked about some of the potential changes that were being proposed to the estate tax limits. So all those sides of things, and we talk about taxes, that was really what we focused on. But again, the big thing we're going to talk about today is ad valorem taxes and property taxes, and what those are. And I think it's important to understand that, like Justin said earlier, it really depends on the state or the county that you're in as to how it's handled. And some counties handle it very well, and others do a very poor job and have kind of a really bad reputation of that. Not to mention any particular county in West Texas that has had a history of property tax issues. And if you have dealt with this, you probably know which county I'm referring to. But anyway, let's talk about the basics first, Justin. What's the difference between property tax versus ad valorem tax and this thing called severance tax as well that we deal with?
All right, so ad valorem, Matt, is Latin for according to value, and it's a value-based tax, not a flat fee or a per barrel charge. This comes down to, for the counties, that mineral interests are classified as real property. So in most producing states, they're the same category as a house or a parcel of land. And that's what gives the counties the ability to tax those separate from the surface. And then there's, like you said, Matt, there's the federal income tax. We've talked about that quite a bit. Severance tax is a state level tax on the extraction of the resource paid essentially by the well or operator and passed through a line item deduction on your check. So quite often, mineral owners, this is something for large owners that they can audit, ensure that this was handled correctly. And Matt, I think this in working interest is a bigger headache when it comes down to the taxation that happens. And then we've got ad valorem and property tax. So that's a county level tax on the value of the mineral interest itself, often billed directly to the owner, separate from any royalty check. So Matt, that's like paying the yearly property tax, like on your house in many states and counties. But it can be different than the tax that's being taken out for severance, which we typically see on our check and is a significant deduction.
Yeah, and those particular taxes, the severance tax and potentially if there's a state production tax, which is maybe a similar thing to a property tax, those are generally deducted from the royalty check by the operator, and you have no say whether or not that happens. That's just by law that happens, and you have to pay that, and the operator and the mechanism is set that the operator pays that on behalf of everyone that's involved with that well, and that just makes it simple and clean, and it's honestly the best way to deal with that. You don't want to have to try to deal with that separately. And the thing that you may think is if you have a lease with a no post-production deductions clause in there, and you see a production tax and a severance tax in there, you may think that the operator is illegally deducting those post-production deductions from your royalties, and that's not the case. Unfortunately, those are just by statute. Those are separate from the production cost and the value that is deducted from bringing the gas typically to market and things like marketing and transportation, and those post-production deductions. Those are separate from ad valorem and other types of property taxes. So yeah, unfortunately, even if you have the best lease in the world with no post-production deductions, you are going to be still on the hook for severance tax and or some form of property tax, whether that's called a property tax or an ad valorem tax, or if it's something like a production tax like in Oklahoma. That is something we just have to deal with. But it's interesting, Justin, because some states handle this very differently, whether the minerals are producing or not producing. Do you want to talk a little bit about the sort of generalities there?
Absolutely, Matt. And when we're talking ad valorem on non-producing minerals, that's typically zero, right? That's part of production coming in. It's not a tax that we see. But then you have the differences in how people handle producing and non-producing. So the moment production starts, that gets recorded, the appraisal district picks up the interest and starts valuing going forward. And that's where you're seeing that ad valorem tax being deducted from your check. And then, Matt, the question of producing versus non-producing, there's really not a universal rule. There are a handful of states that affirmatively tax non-producing and unmined mineral interest using a different evaluation method in those states. An owner can rack up a real collectible tax bill with real tax sale risk. And those minerals have never produced a dime. And Matt, I know in Colorado, you've dealt with this, and it gets even a little bit more complicated because non-producing minerals, when you've got several mineral interests and they're non-producing, Colorado does tax those in some instances, but then in others, they don't.
Yeah, and it's if you own severed mineral interests and that's been recorded with the county, the assessor picks that up, adds you to the tax roll, then you'll start to get that separate tax bill. So I own several mineral tracts in Colorado, and they are taxed separately. And so come, February time period, I'm always on the lookout for those property tax bills because I have to pay those separately for those non-producing minerals in Colorado. And that is just because, again, it's just something that's been picked up. Once it's on the tax roll, it's billed. They want to get their pound of flesh from you one way or the other. And thankfully, it's a very small tax bill. It's like, $3 a year or $5 a year or something like that. And so it's not the value or the expense. It's really the pain and the headache of having to pay it and make sure that it gets paid, because there are implications. And we'll talk about that here towards the end. But if you don't pay the property tax bill, you run the risk of losing the property. And it depends on, the state as to how that would be handled. But it is something to be aware of. And unfortunately, if it is something where you want to hold on to those minerals, you got to stay on top of it. And so that's an interesting situation, and interesting that if you own minerals that haven't been severed from the surface rights, that you won't get a separate tax bill in Colorado, for example. So you would just get the property tax bill for that land and or your home, and then that's how you would pay that. And then I guess presumably that the mineral interest value would be baked into that theoretically, although I think a lot of times it probably isn't. Now, other states, there are a couple other kind of interesting ones that they're West Virginia, they assess severed minerals at a minimum value even before production as well. But it's also like so low that I don't believe that they actually assess it until, it's more of a production type of a thing. Once you have production, they'll start taxing you. So, that's the way it is in Texas is another really important example that you don't pay property taxes on non-producing minerals in Texas. They only start assessing value when it's producing, when you start receiving royalties, and then you'll start to get a tax bill. And that tax roll, in the case of Texas, for example, that comes directly from the operator because they have the division of interest in every well. And so they report that to the county. The county has a whole mechanism for assessing value on your portion of that producing royalty interest. And it's basically, similar to doing an appraisal or evaluation on minerals. You look at the reserves associated with those wells, and then they figure out, how much is being produced each year. And then there's a certain amount of value that goes with that based on oil prices and gas prices. And they have a whole formula for how they do that. But in Texas, an important thing to know is you only start getting a property tax bill once the well starts producing. And so there's others that are kind of in between those two, I would say. So Colorado taxes the severed mineral interests that are non-producing, and that's generally based on the average per acre rental value of leased minerals in the area. So they kind of look at that data, and then they'll assess some value based on the potential income from leasing, basically. But interestingly, it's really very much a state by state situation, and the best thing to do is to actually look at your state and see what property taxes are owed on mineral rights, if any. You can just do a Google search by the state, by the county, just to make sure that you are looking at the ad valorem and or property tax liability that you might have if you've just inherited minerals or if you just purchased minerals in a particular state and you're not familiar with, or it's a new state for you, to do some research to make sure you're on top of things from the very beginning. And we'll have some links in the show notes as well on some of these, but it's always good to stay on top of it because tax law does change.
It does, man. And like you mentioned, the county tax assessor, they're one of the ones that seem to very often have an online way to look up the property taxes owed by either owner name, which may be if you just inherited the name of your ancestor. Typically, you can start there, and the county tax assessor is typically the one to interact with or call. And like Matt mentioned at the beginning of the show, though, it can really vary how each county tax assessor wants you to contact them, how well that they respond. Some of them, in Texas, is really great. You can pick up the phone, call them, and have conversations. And then others are not near as easy to work with. So kind of have to start at the county tax assessor and work your way forward if you have specific questions.
Yeah, and Texas is great. You can search, like Justin said, by that county, just search for the county name and then CAD for County Appraisal District is what the CAD stands for. So just whatever the county name is, CAD, do a Google search, and pretty much all the Texas counties use the same platform. So if you have interest in multiple counties, it'll be very familiar interface. And like Justin said, just search for your name or search for the name of your ancestors, particularly if you just inherited minerals. You want to make sure that they update the tax roll, because I have run into a situation where I acquired some minerals in Texas. I think the previous owner was still getting the property tax bill for those interests and they weren't paying it. And then I was accruing penalties and all those things. It was very much a pain to have to deal with, even though theoretically, when you record a deed, the appraisal district should pick it up and update their tax rolls off, and also the operator themselves, their pay deck will also update. And so that is something that may not happen though. So you want to make sure that you stay on top of it if there's been a transfer of ownership, because you still owe it, even if you don't get the tax bill, as I've learned firsthand, although you may be able to negotiate down some of the penalties if you can demonstrate that you weren't notified and, it wasn't really something that you just ignored. It was something you didn't know about. Maybe you can negotiate with them. Like Justin said, it depends on the county. a lot of them are really good to work with, and you just need to make a phone call and figure out what your options are. But I think one thing also, just to throw out there, one state that's always very different for anything is Louisiana. They have a very different way of potentially handling things, when it comes to minerals and royalties. And so there's this whole mineral servitude situation versus the surface ownership. And generally, I think ad valorem taxes in Louisiana apply mostly to the operator for their well equipment and things like that. But it's important that you stay on top of it for sure. Just with Louisiana being different, that'd be one that I would pay particular attention to. The rest are, I think, pretty straightforward, like we talked about already.
And one exception I think that confuses people, especially in Oklahoma, is that the term ad valorem is used loosely, but Oklahoma doesn't charge a traditional ad valorem property tax on oil and gas production. Instead, it uses a gross production tax. GPT is often how you see it. And that was just enacted specifically in lieu of ad valorem. But typically, owners see this just as others with ad valorem would see that taken out of their check.
Yeah, that's a good one to note. And similarly, in Oklahoma, there'll be particular, if you don't have a W-9 on file with your tax ID, you could see another tax, and this applies to other states as well, potentially, but they might charge you backup withholding or withholding tax for Oklahoma state income tax, because Oklahoma is a state that does levy an income tax as well. So that is something to be aware of. So in addition to those taxes that are property related or severance tax related, there's that income tax potentially that could be showing up. And if you are getting that, and really in any state, if you have a backup withholding or withholding tax showing up, what that is indicative of is the fact that you don't have your tax ID on file with the operator. And so just by law, they are required to withhold, like 30%. So it's usually a good idea to update that, make sure you have your tax ID on file so they're not charging you withholding tax or they're not withholding anything from your royalty checks. You should be able to handle that on your own. And, if you have any estimated tax payments or if it's just a small percentage, then your normal withholding from your regular paycheck, would probably cover it. So definitely something to be aware of if you do see that pop up as well from a taxation point of view.
Setting of taxes is a political facet. And so there's a lot of variation across the states. And New Mexico is one that can be a little surprising the first time you see it. They have a severance, conservation, emergency school tax. And New Mexico's known for new taxes coming and going as far as oil and gas production goes. And Pennsylvania can be a little bit interesting as well, in that they have a per well impact fee. So I think they're a bit unique in that way, which I learned with this show, Matt. That was not something I heard of, but there's all kinds of ways that this taxation can be handled, very specific to both state and county.
Yeah, for sure. So I think the moral of the story, double check the state, double check the county. You can find out more information. And then, talking a little bit about non-oil and gas related minerals, because that is something that we may run into as well, like coal, potash, lithium, as another example. And I would see that the valuation methods probably differ for those, hard rock minerals or other mineral types, but the same logic, I think, applies to those. And all of that's covered in state statute. They're very specific about making sure that they outline how they're going to take your money. And so that is something to look up as well. So if you have coal and or potash or lithium interests, whether it's a severance tax or production tax or property tax, expect that and just, look at the state in particular to find out how they handle that for that particular product or for that mineral. But, interesting, I would say when we think about this from a philosophical standpoint, and, to your point, Justin, I think, we talk about politics and that probably does play a lot into this. But, a big question is, why do some states tax non-producing minerals? Others don't. Why do some states take one stance versus another? And again, it's just how they choose to fund themselves from oil and gas activity and when that choice was made. Probably in the situation of these older states like Texas, Kansas, and things like that have been around and they've been producing oil and gas for a really long time. They have streamlined that often, I think, that whole process. And so the severance and production taxes, they generally consolidate that at the state level. It probably just depends on the lobbyist and who is successful in lobbying for one way or the other at one point in time, or what the particular platform was for the state politicians. But it's interesting that, it's non-producing minerals. Yeah, I would say a general rule is that it's not taxed just because it's so difficult to reliably value that. And I think it'd be very easy if you had non-producing minerals to protest the valuation, particularly in areas where there's no oil and gas activity, no prospect of any sort of future development. I would argue that you could maybe try to get that down to an extremely low amount based on, very de minimis value for those minerals, because the value of mineral rights is directly tied to the royalties that you would receive. And if there's no royalties that you're going to potentially get, or no leasing in that area, that's another source of income, then I think you could have a pretty good case to protest your property taxes. Now, whether practically speaking that makes a lot of sense, if you have a $3 tax bill, to spend all the time and effort to protest that just to not have to pay it, it's really just easier to pay the write the check and pay the taxes each year, because even over your lifetime, it's probably going to add up to less than $100 or whatever. So, better just to pay it and be done with it. But, I think that is, theory, when you think about the theory, you think about the practicality of all of this. I think those non-producing minerals are often just exempted because states haven't figured a good way to reliably assess value. And, that's the fact. And the good thing about that is if you own non-producing minerals, and then you're very likely not to owe anything. But again, that's why we say it really depends on the state, and you really need to do your homework first to make sure that that is the case, so you can have that comfort level. Because if you just ignore it, and for example, you have minerals in Colorado and you technically should have been getting those property tax bills and they were still going to your ancestors, and then all of a sudden they go to a tax lien sale and or tax auction in some states as well, then that could be a situation where you run the risk of losing those minerals. Now, they have to go through the hoops to run title and to identify you, and then hopefully you would get noticed, and you'd have the opportunity to pay that tax bill and to get rid of that lien and to reacquire or to keep that property. But that is a very real risk, and I've seen that happen, and seen the whole process unfold. And they've changed it over time, and different counties and different states handle it differently, or different states really handle it differently depending on the mechanism for assessing delinquent property taxes. Some do a tax lien, some just go straight to like a sheriff's auction after a period of time. But that is something you really need to pay attention to, because it is an opportunity for you to lose your minerals if you're not careful.
All right, man. In practicality, we've talked a lot about it, but let's put it together for everyone. If you're trying to figure out if you owe property tax, and a good time to do this is if you just inherited these, if you just acquired these. This is really a good thing to kind of get a benchmark on, so that you'll understand it the time that you acquire the property. And if you haven't done that so far and you acquired it long ago, then it's always a good time to figure it out. Because again, each one of these can be different and some very confusing. So step one is to identify every county where you own a mineral interest. So like we said, those property taxes are based on state or county law. So finding the county tax assessor is often the seat that you're looking for. You can start with their online tools, look up the owner name, and then check the appraiser's or the assessor's website, see what you can find. Like Matt mentioned, in Texas, they have what's called the CAD, CAD, and that is true for most counties in Texas. And I think most have that digitally available, where you can at least look what you owe, write a check, or in many of them now you can also pay online. Production status is important. That will kind of tell you whether you might owe something. That in conjunction with looking up how the state handles it, so that you know what's coming. And then wherever the registered address is for this property, depending on what the entity structure is, that could be an LLC, could be a trust, could be an individual, but you're likely getting the notices to that registered property address. And taking a look, figuring out what that property address is important and can keep you from getting into some issues. All right, Matt, what else are we missing there?
I think that the biggest thing is, if you do get notified that you are delinquent, don't panic, but then also don't wait and don't put it off. I would be very timely in paying that and redeeming those taxes. In other words, paying the past due taxes as well as the penalties and interest, because those redemption windows are fixed. and you have some hard deadlines you'll be dealing with. And so usually by the time you get that delinquent tax notice, you're looking at having not paid taxes for over a year at least, because typically what happens, any unpaid taxes to go to a tax lien sale or tax auction after a certain period of time. And in the meantime, they've been trying to get a hold of you. And then eventually, if they do, maybe you're at the point where you get that notice. It's been a couple of years of not having paid those property taxes that maybe you didn't get the tax bill, but either way, you're still on the hook for now that you're the owner of that property. And, it'll have very clear guidelines on any sort of tax bill that you get as to the time periods and the amount that you owe. And so, like Justin said, I would say 95% of counties now are online or have the way to accept payment online for property taxes. That's probably one of the first things that they digitized in most cases, just because they want to make it easier to collect your money. And in paying the property tax bill, in my experience, you usually don't have any fee if you use an e-check. You do your routing number and your checking account number, and you enter it in and you pay that way versus using a credit card or some other debit card or something like that. They typically will assess a little fee on top of that, which usually is not too high, particularly if the tax bill isn't a lot. Maybe that's easier, more convenient way to pay. But just know that each county may have a specific way to pay, and just be looking at their website and look at the tax notice to learn exactly what you need to do. And then if you have a question, like Justin alluded to at the beginning, give the assessor a call or give the treasurer a call just to make sure that you're doing what you need to do to pay and that everything gets cleared up. Because oftentimes if you give indication that you are going to redeem, they can be aware of that, be on the lookout. They can give you some specific instructions to expedite payment, maybe if it needs to be made before the tax sale happens. Because basically up until that gavel goes down, you have the ability to redeem those taxes. And even after that tax sale, let's say you miss the deadline, it goes to auction. Usually there's some grace period, or there's a period where you can still redeem, for the amount that perhaps was sold for, but you can at least redeem it and get that property back for at least the property taxes and the penalties, or maybe more, depending on this, the state. There'll be a penalty that goes with it. For example, in Colorado, if you are going all the way up to the point where that treasurer's deed auction occurred, there's a whole set of application fees that the tax lien holder has, if they want to redeem that or they want to convert that into a treasurer's deed. It goes to an auction. There's a whole notification period. There's an actual auction itself that occurs online. And then whoever the high bidder was, that there's a time period that you can either pay the penalties and then reacquire or keep that interest, or it goes to that high bidder. And one of the things that with non-producing minerals, the actual title search fee is $3,000, which is about how much it costs to run title on minerals. And because they have to do that to identify all the owners and all the heirs and to be able to notify them, that's why that fee exists. And if you want to keep your minerals, you have to pay that fee as well as the application fee and all the other things to reimburse the tax lien holder. So it's not potentially just the property tax bill that you would be on the hook for and the penalty and the interest. You might have additional fees if you wait until the very end, until an actual tax lien holder applies for a treasurer's deed. Then there's going to be additional fees on top of it. So once you find out about any past due taxes, it's really important to pay them as quickly as possible if you want to not run the risk of losing them. So I think this is probably a good place to wrap up. I don't really have anything else. Anything else you're thinking of, Justin, that we missed?
No, Matt, I think just ensuring that you, contact the office, you get those unpaid taxes paid is really the key takeaway there. And knowing where you own it, and then knowing whether non-producing or producing minerals are automatically taxed is really the two biggest keys to make sure that you stay in good favor here. And if you just acquired this, it's worth taking a look to see if you owe taxes.
Yeah, I think that's a good way to wrap up. And like we said, we'll have links to information for most of the oil and gas producing states in the show notes, which you can find at mineralrightspodcast.com. And, another, I would say, action or key takeaway is if you don't know what you own, this is maybe a good time to think about performing a cursory title search in the counties or states where you know that you may have inherited minerals, but maybe you are trying to get a handle on everything, I would say this is a good opportunity to do that, because there's this whole property tax angle, which means that if you aren't aware of what you own, or that it's out there, that you could run the risk of losing those because you're not paying the property taxes, even though you should be. And so obviously, if things are handled in a timely manner, things are gone through probate, you've got a personal representative's deed, the interests are in your name, that's usually a trigger for the county to catch that and to start sending you the property tax bill. But in many cases where we've inherited minerals that are still in an ancestor's name, they're still sending that property tax bill to your deceased ancestor. And then after that time period goes by where that tax bill isn't paid, that goes to the delinquent tax roll, and then it goes to potentially an auction or a tax lien situation. So, it's a good opportunity if you have stuff out there that you've been kind of putting off, trying to get a handle on and understanding what you own. Now's the time to maybe start to pay attention to that and do the research. And if you want to learn more how to do a basic title search step by step, I have my mineral management basics course where you can learn to do that, learn the important documents you should have, the production status of any wells that are on your minerals and things like that. And we go through all of that in step-by-step manner for most of the oil and gas producing states. So you can find out more about that at mineralrightspodcast.com/courses. And then one last pitch for the National Association of Royalty Owners. If you aren't a member, this is a thing where we talk about taxes. We have accountants and attorneys give webinars, presentations at our conventions where you can learn more about this topic and others. And to learn more, go to join-narrow.org. And you can use the code MRPodcast to get $25 off your first year introductory membership if you're not a member. So definitely check into that if you aren't already a member as well. So thanks again for listening, and we'll catch you in the next episode. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.